Welcome to Beaufort Investment's quarterly review, focusing on our Series 3 equipped portfolios. Our focus shifting from political uncertainty to the changing tack of central banks. We thought the Federal Reserve would avoid a taper tantrum or implementing the deflating of their burgeoning balance sheet. This view is predicated on the clear communication style that has been a trademark of Janet Yellen's tenure. In terms of what we did to the model portfolios, we made 4 fund changes at the start of the previous quarter, reducing our exposure to both UK and US equities. Low volatility for the equity markets continued for the fourth quarter, with the VIX index recording 9 of the 10 lowest levels ever last year. This was complemented with equity markets hitting record highs. The S&P 500 hit over 60 record highs last year, with the last quarter's return driven on the back of US corporate tax changes. This resulted in an unprecedented rally for the index, returning a positive gain for all 12 calendar months, the first time this has happened since the index was created in 1923. The rally was not isolated to the US though, with the World Equity Index enjoying a 14-month consecutive streak and our own FTSE 100 hitting a record high on the last day of trading. Central banks did start to tighten, with the Federal Reserve initiating its tapering programme, the European Central Bank halving its asset purchase programme, and the Bank of England raising interest rates for the first time in a decade. It was a strong quarter for the equipped model portfolios, marking 7 consecutive positive quarters. Most importantly for us, the return profile is in line with the level of risk being taken. The higher the risk, the higher the returns. The performance was helped by overweight position in Asian equities, which was one of the standout asset classes in 2017. We think 2018 will be another positive year for global markets. However, that is not without some concerns. Whilst we have become accustomed to the political uncertainty that has been prevalent since the end of the global financial crisis, the biggest concern for us are the world's central banks. The experiment that was quantitative easing is coming to an end, and while it was successful in avoiding the Great Depression, the consequences of unwinding the largesse are unknown. We have the Federal Reserve, European Central Bank and Bank of England all embarking on some degree of monetary tightening. This is a new paradigm, with only the Bank of Japan, as one of the 4 major central banks, still providing stimulus through monetary policy. Where our concerns lie is with those central banks that are tightening policy and are changing the guard. The Federal Reserve will have a new chair next month as Janet Yellen makes way for Jay Powell. The European Central Bank will have a new president as Mario Draghi steps down, and although not yet confirmed, the Bank of England's Mark Carney's original tenure as governor is due to end in June. That means that 3 out of the 4 most important central banks around the world will have new leadership, whilst entering a new phase of policy tightening. This just leaves the Bank of Japan in status quo, and also is one of our favourite asset classes for the year. The changes being made for the start of 2018 are focused on income portfolios. We are replacing lower yielding funds with funds that offer higher, sustainable levels of income. So thank you for watching. For a more in-depth look at our views and fund changes, I would encourage you to read our quarterly review, available to download from our website.